Hey everybody, Ed Conarchy. Welcome back to Conarchy's Money Corner. Hey, on this video I wanted to talk to you about your blended interest rate. No, not your mortgage rate. Your blended interest rate. See, one of the things that we find is that clients, consumers, humans, human nature is to take something and put it into a silo all by itself. We're guilty of what behavioral science calls compartmentalization. So when I talk to clients all the time, what gets talked about is, hey, my mortgage rate today is 3.79%. So I have a client I'm currently helping today that they have a first mortgage of 3.79%, which sounds really good, right? I mean, obviously interest rates have gone up since the presidential election. As I record this video today, the 10-year Treasury has eclipsed 3% and mortgage rates are going higher. The national average rate put out by the Mortgage Bankers Association this week is 4.84%, but that's with paying lots of fees. Obviously, I'm a big fan of a no-fee mortgage, so you would creep up into the low fives. Why would anybody then, if they had a mortgage rate of 3.79, why would anybody ever want to go to a rate in the fives or the low fives? Because it's something called your blended rate. See, the mortgage is fine. That first mortgage at 3.79 is fine. But with this client, that's a 3.79% 15-year fixed mortgage that they were told to get. Because they were told that in 16 years, they're going to be in great shape without a mortgage payment. And we hear so many people talk about this. One of the most famous persons that believes in a 15-year fixed mortgage is a financial, what will we call him? A financial expert? I mean, he's a gentleman who has TV shows, who has radio shows, and writes books, but he doesn't carry a license as an investment advisor. He's a debt elimination specialist. His name is Dave Ramsey. You may have heard him. And he says, get a 15-year fixed and pay off your mortgage in 15 years because in year 16 you won't have a mortgage payment, which sounds great. But what he ignores is life, kids, jobs, loss of jobs, reduction in income, medical crisis, the roof leaks, the car breaks down, appliance goes out on us. And guess what? Life happens. How many times do we write a check? My wife and I will always kid when we write a check for the house, the joys of home ownership as we're paying for something. So in real world, getting a 15-year fixed and paying it off and not having a mortgage in 16 years ignores year 1 through 15, the 15 years of costs. And with this client, just like any client, they had the 15-year fixed mortgage, but they have children. And as we like to say in the financial planning world, there are two types of people in the world: rich people and those who have children. That if you have children, you know what I mean. That expenses have happened. They've experienced all those things. And guess what? They've needed money. And because they had a high 15-year fixed mortgage payment, they had to go to other resources. They went to a home equity loan, and they went to the dreaded credit cards to help their cash flow. So, yes, they have a 3.79% mortgage rate, but their home equity loan is 8.24%. Can you believe that? 8.24%. And if you can believe this, on home equity loans, and I've been telling you about this, there's usually a very high cap on how high the rate can go to. Their rate can go to 25%. Yes, their home equity loan can go as high as 25%. And then they have amassed money on their credit cards with an average rate of 17%. So the math here to get our blended rate, because we now really need to look at all the rate. What's the debt on all? What's the interest rate on all the debt? So they've got $136,000 at 3.79. They have $15,000 at 8.24 and $42,000 in credit card debt at 17%. If we were to blend that all together, and I've got a calculation to do that for you, and I'm happy to do that for you, answering the question of what is your blended rate. But when we blend that all together, the average of all that debt is 7%. No, they don't have a 3.79% mortgage rate. They have a blended rate of 7%. We can combine all that debt together into one mortgage, at one lower interest rate and cut their payment. In fact, we would cut it more than half. If you look at all the minimum payments on the credit cards, the mortgage that they have, and the home equity loan, the total payments today are $2,300, and we're able to refinance them into all that debt into one mortgage at a lower blended rate that they have today for a payment of only $1,100. One, reducing their cash flow $1,200 a month, and two, potentially having a greater tax write-off. I say potentially because your tax professional needs to answer that question. So the question I have for you is, if you've got a really low mortgage rate, do you have other debt? And if you have other debt, then what is your blended rate? And if you don't know how to calculate your blended rate, call me today, email me today. I will calculate your blended rate for you, because you may have a higher blended rate that you could get on a higher mortgage rate today, and do what this client did, cut their payment and potentially get a greater tax write-off. So my question to you today is, do you know your blended rate? If you don't, contact me. Hope you enjoyed this Conner Keys Money Corner. Talk to you next time on Conner Keys Money Corner.